How many types of markets do you know? Are you trading in NSE or BSE? Then you're trading in secondary markets. Did you acquire shares of Nika, Devayani, MTAR from IPO? Then you bought it from a primary market. What are the types of IPO process? Apart from primary and secondary markets, are there any other markets? Let's check out all these information in detail in this video. Hi everyone, welcome to FinBytes. Apart from various asset classes, our markets can be classified into following types: primary market, secondary market, OTC market, third and fourth market. Primary market. In simple terms, primary markets is a place where securities are created to public for the first time. It's in this market where companies sell new stocks or bonds to the public for the first time. Example of a primary market in stock markets are IPO, initial public offering. We would have heard many stories that someone invested during an IPO doubled or tripled his investment in a very short time. It is true, but as always, there are also negative sides of the IPO. So don't jump into buying all the companies which floats its shares through IPO. Always steady, understand the business model of the company, and only if you understand the business and expect a good growth prospects, apply for the IPO. Otherwise, you won't have the conviction or confidence to hold the stock for a longer term. Overall, an IPO occurs when a private company issues stocks to the public for the first time. These trades provide investor an opportunity to buy securities from the bank that did the initial underwriting for a particular stock. Underwriter. The underwriter in a new stock offering serves as the intermediary between the company seeking to issue shares in IPO and investors. The underwriter helps the company prepare for the IPO, considering issues such as the amount of money sought to be raised, the types of securities to be raised, and the agreement between the underwriter and the company. There are various types of underwriting agreements, but that's beyond the scope of this video. So let's take an example how the IPO process works. Let's say company ABC hires 5 underwriting firms to determine the financial details of its IPO. The underwriter details that the issue price of the stock will be Rs 2000. The investors can then buy the IPO at this price directly from the issuing company. However, allotment of shares is not guaranteed every time. To understand more, check the next section of the video. Types of IPO. There are 2 types of IPO: fixed price issue, book building issue. Fixed price issue. Under the fixed price issue, the company sets a fixed price at which all their shares will be offered to the investors. To make this happen, a company hires a merchant banker, an entity that will appraise and reduce the level of risk for a company. In this type of IPO, all investors know the price of a particular share decided by the company before the company enters into public. They pay the total fixed price while subscribing to the IPO of a specific company. Book building issue. In the book building issue, the price is released during the process of IPO. The company sets no fixed price in this process, but there are 2 different price bands. The lowest price band is known as floor price, and the highest price band is known as cap price. However, investors interested in buying the shares have to make a bid within a demanding time before the company sets the price. In the end, the final price depends entirely on the bids the company obtains from the investors. Let's check out some key difference between fixed price issue and book building issue based on certain important parameters. So the first parameter we'll be considering is pricing. So in a fixed price issue, the price of the share is already decided, whereas in book building issue, the price is not specified and only the pricing band is fixed initially. Second parameter is demand. In fixed price issue, the demand is known only after closing of the issue, whereas in book building issue, the demand can be known every day. Third parameter, payment. In fixed price issue, investors have to pay 100% advance payment of the share price at the time of bidding a share. Whereas in book building issue, the payment is made after the allotment of the shares. Fourth parameter, reservations. In fixed price issue, 50% of the allocations are reserved for those who have investments below 2 lakhs, which we call it as retail investors, and the rest is given for high amount investors like HNIs and QIBs. Whereas in the book building process, 50% of the allocations are reserved for qualified institutional buyers, 35% are reserved for small investors like who have capital less than 2 lakhs, and the rest are reserved for other categories of investors. Well, this is not always the same, but again it depends from company to company. One important thing to understand about the primary market is the securities are purchased directly from an issuer. The secondary market. For buying equities, the secondary market is commonly referred to as the stock market. This includes our stock exchanges like National Stock Exchange (NSE), Bombay Stock Exchange (BSE), and all major exchanges around the world. We have made a detailed video about NSE BSE, and if you haven't watched the video, check out the video link in the I button. This video will give you a clear understanding about our stock exchanges and which exchange is suitable for retail individuals like us. So coming back to the video, the importance of secondary market is that investors trade among themselves. That is, in the secondary market, investors trade previously issued securities without the issuing company's involvement. For example, if you go to buy HDFC Bank stock, you're dealing only with another investor who owns shares in HDFC Bank. HDFC Bank is not directly involved in this transaction. Secondary markets can be broken into two segments: auction markets, dealer markets. Auction market. In the auction market, all individuals and institutions who want to trade will announce the prices at which they are willing to buy or sell. These are referred to as bid and ask prices. The idea is that an efficient market should prevail by bringing together all parties and having them publicly declare their prices. Most of us have been using this system when we buy or sell the stocks. The second type of market is dealers market. The dealers hold an inventory of security, then stand ready to buy or sell with market participants. These dealers earn profits through the spread between the prices which they buy and sell securities. An example of a dealer market is olden days of Bombay Stock Exchange, in which the dealers who are known as the market makers provide firm bid and ask prices at which they are willing to buy and sell a security. The theory here is that competition between dealers will provide the best possible prices for investors. OTC markets. Sometimes you will hear a dealer market referred to as an over-the-counter or OTC market. The term originally meant a relatively unorganized system where trading occurred through dealer networks. This term was most likely derived from the off-Wall Street trading that boomed during the Great Bull Market of 1920s, in which shares were sold over the counter in stock shops. In other words, the stocks were not listed on a stock exchange, they were unlisted. Nowadays, the term over the counter generally refers to stocks that are not trading on the stock exchange. Third and fourth market. We might hear the terms third and fourth markets. These don't concern individual investors because they involve significantly huge volumes of shares to be transacted per trade. These market deals with transactions between broker dealers and large institutions through over-the-counter electronic networks. The third market comprises OTC transactions between broker dealers and large institutions. The fourth market is made up of transactions that takes place between large institutions. The main reason these third and fourth markets occur is to avoid placing these orders through the main exchange, which could greatly affect the prices of the security. Since access to the third and fourth market is limited, their activities have limited effect on the average investor. I guess you would have understood in detail about the types of markets. If you have any questions, do comment below. I will read everyone's comment personally and try to answer it. If you like the efforts put into this video, hit the like button. If you are visiting our channel for the first time, subscribe to our channel and press the all notification bell icon to not to miss any future video. Thank you and have a great weekend. Bye.